John, I mentioned Airbnb. Their CEO, Brian Chesky, coming up here in just a few minutes. Let's check back on the markets today, and it was certainly a positive momentum mover today on this hump day. 415-point gain on the Dow, about 1.3%. The big winner, once again, the Nasdaq up 2.6%, led by Microsoft and Apple and Alphabet and Amazon, and the same names have driven us since mid-June. All right. Let's get to our panel now and check in closer on the markets. Loreen Gilbert, WealthWise Financial CEO. Omar Aguilar, Schwab Asset Management CEO and CIO. Good to see you both. Loreen, let's start with you. The floor is yours. What is driving the markets for you? What's driving the day?
Well, it is all about earnings. And we came into going into the quarter here now, looking at the last quarter, thinking we would see maybe 4% year-over-year earnings growth. It's been much stronger. Many companies have been able to maintain profit margins despite cost increases. And so it is all about earnings. And then we continue to get good data. ISM numbers came out today and they were positive in that growth territory. So, still the data that we're getting, while we are in a slowing economy, we still see positive data.
Omar, what do you make of the positive action that we saw today, the Dow closing up just over 400 points? Is some of this optimism warranted?
Well, it may be, I think it's related to positive news on earnings. Just to think about psychology for investors as we go into 2022. We have had a year where it has been full of negative news across the board since the very beginning of the year. And I think any positive catalyst that will make investors find opportunities to get into the market, they're probably being rewarded. And in this particular case, as it was just said a second ago, earnings related in a period where everybody expected decelerating of profits, decelerating of margins, warnings on outlooks is welcome. I also think that there is a component that, investors are trying to still digest the fact that they heard a very dovish Jerome Powell and Fed with the thinking that maybe the majority of the rate hikes are behind us, and that may turn out to be a little premature.
Let's follow there, Loreen. Do you feel that there is a dovish Fed talking? Or are you focused on the last couple of days with Daly and a couple of others that sound rather hawkish, wanted to almost clarify what Jerome Powell said?
Well, I think they are on a tightrope. We know that, and they know that. And so everybody's trying to be careful with what they say because they don't yet know what they're going to do next. I think we've had the 275 basis point rate hikes. I think we still see another 50 and maybe two more 25 before we see them really take a pause. However, they're leaving themselves enough room that if they need to take a pause sooner than that, or if they need to change that, they will. And so I think they're doing the right thing, looking at how the economy fares as these rate hikes go into effect, and then looking at what happens after that and how they're going to respond.
Omar, as it stands today, S&P up about 13% from that June low. We have seen, though, some volatility in the markets over the last several weeks. Is that what investors should be bracing for, at least here over the next couple of weeks?
I think we need to continue to be expecting volatility going forward. The amount of information that we're going to receive in the next few weeks and months, will continue to drive market volatility. And I would say it's not just equity market volatility that, is probably the more visible for investors. The bond volatility has been probably higher, in the last several months than it is on the equity side. Just the move on the 10-year yield from, 350 to where we are now at 270, it's just massive for that particular market, which basically shows a lot of the, confirmations of the fact that, we're in a slowing economy. There is a probability of a recession, and that the central banks are trying to not necessarily go too fast to try to get that recession going. So that volatility is certainly something that we'll need to continue to get adjusted to.
That move on the 10-year, Loreen, tells you what is coming.
Well, I think something to be looking at for investors is to start looking at continue to keep their bond allocations and even go longer duration. at this point. But what the market is telling us is eventually the Fed is going to reverse course, right? So while we've been in this rising interest rate environment, the Fed could dramatically change that as they see the economy slowing, and then they could pull back. And so that's where there is this confusion right now in the bond markets. But for investors, as you know, as they're looking at their allocations, certainly bonds are starting to act more like bonds again, and then looking to increase the duration as those yields on the long term go up.
So Omar, what does all this mean for portfolio allocation? Where are you seeing the most attractive opportunities today?
Yeah, good question. Well, there's no question that, you know, the risky assets continue to, relatively to bonds, continue to be more attractive. You know, if we are in this interest rate hike, inflation is still, you know, pretty high, and therefore, in an effort to try to get us to the right place, you know, the expectation that there will be a pivot by the Fed is probably way too premature. I think, you know, the neutral rate that the Fed has set up compared to the levels of inflation we have clearly, you know, give us the sense that, you know, inflation expectations may come down a little bit, but may not necessarily, you know, be as fast as people expected, while we still have significant amount of supply chain disruptions. When you think about that, and when you think within equity markets, you know, we are in the last phase of the economic cycle. During that period of time, you know, the ability to stay defensive and start planning for the change in direction in the market is probably, you know, a good strategy. So we're suggesting to clients to do a barbell where they stay defensive in a low beta, you know, areas that will, you know, withstand the volatility we're going to see going forward, but start position themselves for what it comes ahead, which tends to be more growth oriented, that tends to be more technology and EPS growth oriented. Stay high quality and stay in areas that will benefit from this environment.
All right, got to leave it there. Great conversation. Omar Aguilar, Loreen, Gilbert, good to see you both. Thanks.